Welcome to the Restaurant Boiler Room, Season 7, Episode 2. I'm your host, Rick Ormsby, Managing Director at Unbridled Capital. Today in the Boiler Room, I'll be talking about some thoughts from the recent Multi-Unit Franchise Conference, MUFC, in Las Vegas, as well as a quick chat about market conditions right now. I'll also talk about sale-leaseback financing in today's environment and give an update on our deal flow. The Restaurant Boiler Room is a one-stop shop for multi-million-dollar merger and acquisition activity and financial complexities affecting the franchise industry. We talk money, deals, valuations, and risk, delivered to the front door of franchisees, private equity firms, family offices, large investors, and franchisors on a monthly basis. Feel free to find our content at Unbridled Capital's website at www.unbridledcapital.com. Now, let's enter the boiler room. So as I talk with you here, it's a beautiful sunny day in Pensacola, Florida. Just got back from last week at the Multi-Unit Franchise Conference, MUFC. Believe it or not, it's the first time I've ever been to that conference. I'm usually a big RFDC guy. I think I mentioned on our first podcast of the year, if I did not, that we were awarded our 7th Deal Maker of the Year award in the last, I believe, 5 years. How awesome is that? So feel honored and blessed about that. We won it this year as an advisor for the work that we did. And I think probably sometime in mid to late April, Franchise Times and the Restaurant Monitor will be coming out with Deal Makers Week. And I think I'm going to be on a panel with a couple of folks talking about valuation trends and market conditions and M&A for the franchise industry, primarily the restaurant franchise industry in this panel. But it'll be in a couple weeks, so check it out. Check out the social media for it, and you can always get all this stuff if you just connect with us at Unbridled Capital on LinkedIn or some other platform, and you'll be able to hear it also through our website at unbridledcapital.com. So that was a real blessing. I'm thankful for that. But this was the first time I'd been out at the Multi-Unit Franchise Conference. And so pretty good convention, and just in terms of size and breadth, it felt a lot like the size and a little bit like the layout of RFDC. David Ostro, a big Taco Bell franchisee and someone I know pretty well, is the chairman. And so he did a great job. He's a natural up there. But it was a good convention. And what makes this one a little bit unique is Unbridled is also exploring and doing more work outside of our traditional legacy concepts in the QSR industry, and also going after bigger growth areas of franchising in general. Is that this particular convention feels like it's about, half or maybe 2/3, no more than that, restaurants, a series of other types of brands. You have health and wellness and beauty and fitness and, car services and a lot of coffee and a lot of new startup concepts, or small franchisors. There were a lot of franchisors there. We're just trying to, like we all are, trying to look at the next wave of franchising and kind of, I don't mean this in a negative way, but just with the amount of years behind some of these legacy concepts in the QSR side. And of course, franchising was basically almost a restaurant-only affair 20 or 30 years ago. So it's one of those things where, just a lot of the older franchise concepts are just by nature going to be large, big box franchise restaurants. But that model is changing. A couple of things that I saw are really kind of interesting, and I'll talk about them in a minute. But let me pause for a second and have you guys and girls who are listening, if you have, I've never asked this, I don't think, on any podcast, but if you have a particular topic that you would like me to talk about, email me. You have my email address, I know, if you subscribe, or reach out to me on social media or otherwise, phone call, text, whatever. Sometimes our industry changes abruptly. And I've had a lot of people ask me, kind of one-time questions that, in person that they wouldn't have asked if they didn't have a chance to see me. And I thought to myself, well, if listeners to the podcast and watchers of the webinar have questions, bring them in. I'd be glad to talk about them and bring them onto the podcast and answer them for you. Because I'm sure if you're asking, others are wondering as well. The first thing I'd probably talk about is deal flow. Our company we just closed, I think, 3 or 4 transactions so far this year as of the, end of March, the most recent of which is a Sonic business, a smaller Sonic business. And then we've sold a couple of Burger King businesses as well. And we closed a large Pizza Hut business. That's what's happened so far this year for us. We've got probably 6 or 7 other transactions that are live and probably another handful that are actionable that we're working on that we're going to be bringing to market in about 3 or 4 different brands over the next, I would say, 60 days. We have again, unfortunately, been in this kind of holding pattern, everyone, about looking at a lot of potential possibilities, to take as clients. We go down the route of doing evaluation, which we do in every case. And, like 90% of the time so far this year, we're running into the same problem we ran into last year, which is we feel like the businesses are worth 20 to 30 to 40% less than what the clients want. And these aren't like clients that are wanting, in many cases, outrageous prices. It's just that their EBITDA has dropped a little bit or a lot in the last 6 months. There's something going on in small town America, rural markets especially, in the last 6 to 7 months. And maybe that's just because where people are living closer to the eat what you kill kind of living. They're the ones that are really getting affected badly by the inflationary pressures in our world. I'm not sure. Either way, it's creating in a lot of the deals that we're seeing a valuation gap that doesn't enable us to take the transactions. And so I think we've probably looked at 20 deals so far this year that we might take, and we've only taken on like 3 or 4 new assignments, that's really low. It's usually a lot more than that. So I know there's still some pain in the industry. There continues to be a bifurcation of brands that are doing really well. They tend to be either really dominant category leaders, whatever it is, restaurants or not restaurants, or it's the brands that are on the low end of the food chain, the ones that are serving kind of the lowest cost product or service in the space. So if you're, not a category leader and you're not a low cost leader, you're probably struggling right now, unfortunately. I don't know how long this will last, but it doesn't look like there's going to be a panacea that's just going to break us out of it anytime soon. And I said this maybe 3 or 4 months ago, but we have a consumer demand problem and a consumer, just a health of a consumer problem in our country right now that has to get rectified. I'm optimistic it will, but there's no easy solution. And because of this, a lot of our would-be clients and a lot of brands, especially the legacy brands, continue to show negative sales performance. And not to call anyone out, because it's really, I wanted to correct what people thought online was a big deal, but KFC moving their headquarters from Louisville all these years to Dallas is really not that big of a move more than just symbolic, was it? I mean, if you look at the details, I believe it's less than 500 jobs. Someone may correct me if I'm wrong here, but the number of jobs that are going to be relocated to Dallas are quite few. And a lot of the operations were likely being, at least on the executive side, were being accomplished in Dallas anyway. So the move of KFC down to Dallas from Kentucky is, probably got more press than it deserved. Negative press about we're leaving, we're consolidating kind of stuff, but it probably was not as meaningful. But sales and profits are down, not just, KFC is one example, but lots of brands down right now. So let's hope that this summer brings a little bit of a better structure. Obviously, most brands that have been struggling started struggling in the back half of 2024. So just by the simple nature of our short-term focus on comp sales, period over period, year over year comp sales, it should have easier rollovers starting in the summer of this year. It's certainly the latter part of the summer. And then, of course, people want to sell things typically and finance things based on looking at strong trailing 12-month or trailing 13-period financials, which means that if that's right and we do start seeing an uptick, in the third quarter, maybe this time next year, some operators are experiencing healthier P&Ls. I don't know. But we're still seeing just a tremendous drop in just the amount of supply of restaurant companies and non-restaurant companies on the market. I do hear a little bit about fitness doing well. That was something that I heard blow through the hallway at MUFC quite a bit last week. So I know that area is growing a little bit. But then again, you have to be kind of careful there too, because some of the health and beauty and fitness brands that are attracting kind of a higher price point are the very ones that are, have clients that are the most succumb to a difficult economy where they're trying to pinch pennies, right? So let me share with you a couple of insights from the convention. One was new franchise brands across the industry. It would not be interesting, just general note, to know that fast food and other fast food kind of chains still probably have the highest growth rate in terms of new brands being added in the last several years, right? Right on its heels in terms of new concepts, health is number 2, fitness seems to be number 3, and then coffee and tea is number 4. And then there's a big kind of drop off from there. I was kind of, I guess not surprised, but just made aware of like the push of health and fitness brands and then of coffee brands. So those 3 collectively have outpaced the growth in new fast food or restaurant concepts over the last few years. That would be interesting to know. Here's another one that I heard in one of the sessions that I thought was particularly interesting. Investment cost. How much does it cost to build your location? And I think this speaks to a larger problem. But if you were to look at a kind of a graph, some of these automotive brands and service related brands and business service related brands, personal service brands, they have all managed to lower their investment costs for their new locations, at least in this kind of just would be, scenario that I heard that it's probably because a lot of them are virtual and a lot of them have been flexible to change their business model. But retail and food, the investment costs are up roughly 15% year over year and not decreasing. And at least the graph that I saw at the convention was pretty stark. It showed how food and retail is spending more money to develop new units than they used to be. And everybody else on the list is spending less money. And I think that is going to go into a comment I'm going to make in a little bit. Heck, I might just as well make it now. I was on the phone with a private equity group that, looks at the franchise space and invests in the space quite regularly. One of the principals told me, goes, Rick, I just don't know how you fix the investment problem for restaurants. In the short term, the cost of new development has gotten so high with inflationary costs that there's just no return on investment for new unit growth. And without new unit growth, a lot of professional investors in the franchise space just aren't active. And that is pretty consistent with what we've seen on our deal flow. I mean, a lot of the people buying the deals that we have for sale are strategic buyers who are, maybe operate in the brand already or operate in a non-competitive brand in similar markets and want to leverage their G&A to grow their business. I mean, folks that aren't looking as professional investors do for like a growth, like a 5-year return on their money and a growth of their, a big multiple of their invested capital. But I think that's that chart that I kind of saw at MUFC kind of popped in my head about that. It's like, and then the conversation with the private equity guy, it's like the cost of new development is just too high. And frankly, we probably have too many restaurants in particular in the franchise space, right? So the problem is that franchisors have not caught up to this model. And I'm getting more and more calls than I've ever gotten from franchisees trying to explore a sale because the franchisor is not allowing them to either close underperforming locations because labor and food costs have come up so much, or they're still enforcing these really egregious development agreements that just don't make sense anymore because the new development costs are too high. So that is out there. Now, what can QSR, what can food do to solve the problem? They've got to come up with a solve because it just doesn't, the returns aren't there the way they were. The cost of construction, what do you guys think? It's at least 50% higher than it was 5 years ago, right? Might even be more than 50%, 70% more, and sales and profits are less. So, it becomes a real tenuous thing. And if you're going to get into a brand or if you're buying a business and you're negotiating a development agreement, just remember, look at it as an obligation, not an opportunity, and make sure you are realistic about what you're signing up for and the penalties if you do not build. Another good friend of mine who is signing up for a new franchise, right? And it was in the health and beauty space. And of course, in the FDD language, it talks, a lot about, liquidated damages if you sign the, agreement to build and to be a franchisee, and then you don't build your first unit, it doesn't open on time. So for those who have multi-unit development agreements with dates and penalties, make sure you're aware of that. And if you haven't signed those agreements yet, make sure you look out for them, okay? Another comment that I saw out here, square footage. This is an interesting one. So the average square footage in the last year of these just locations that this one gentleman was talking about at the convention, I can't really corroborate this. Don't take this as gospel, but maybe it means something here, and I think it will. The stat that he was showing up here was that the average square footage has decreased by almost 30%, across all these different brands in the last year. I don't know what this is reference to, but directionally, this business-related, service-related franchises and automotive franchises and personal services franchises are showing major amounts of decrease, while, again, the square footages are increasing for retail and food, kind of marginally. That's another challenge, right? The delivery mechanism continues to need to be smaller and more efficient, more cost effective. A couple of other comments. I heard people talking a lot about inflation out there. They were talking about a lot about labor inflation and then obviously food cost inflation too, if you're a restaurant franchisee. As I started chatting with some of the non-restaurant folks, people in fitness and health and automotive and service and coffee, they don't have as much of a worry. They do, but inflationary concerns don't bother them quite as much as someone like a restaurant franchisee, especially in sit-down restaurants where you have such a big, heavy burden of labor and food cost. And both of those have just had such a big upward tweak recently over the last 3 or 4 years. So anyone who has like a restaurant company, especially like casual dining restaurants, are really concerned about inflationary costs, as are the health clubs and gyms, but they seem to be less concerned about it just from a taking the temperature standpoint than maybe some other folks. One of the things I talked with a lender, he kind of had mentioned that our delinquency rates are starting to rise a little bit. And I think that's happening on credit cards and things like that too. So we watch that, we continue to watch that and see. I have had an uptick in the amount of distressed people that are calling us. But, equally speaking, we do get a bunch of phone calls from people who have great businesses that are doing really well. I mean, golly, if I said it once, I'd said it a million times. But like Taco Bell, a lot of our clients are up tons in sales right now, and you still have the Wingstop story is great. And I just talked to a Little Caesars franchisee recently who's doing well. That's kind of like a low end customer and they're the lowest product cost, right? And the lowest. And so they're doing well. But some of the ones, the tweeners in the middle kind of don't do, kind of can't say the same. I use the word tweener, and the other day someone's like, what's a tweener? And I'm like, the best example I have of a tweener is someone like Charles Barkley when he played basketball. And boy, he played it well. He's like, I've stood next to Charles Barkley and gotten a picture with him at an Auburn basketball game. I'm 6'4", and I think I had like 1 inch kind of, like boots on at the time. So I was looking 6'5". And I was the exact same height as Charles Barkley. He played unbelievably at 6'5" to be sometimes a point guard and sometimes a center. I mean, just what an unbelievable skill set he had. But he was kind of a tweener, wasn't he? At 6'5", could you imagine him playing center at 6'5" in today's NBA? But yet he had the skills of a center, but was too short. Out on the perimeter, he couldn't shoot the ball quite well enough as today's point guards and shooting guards who might be an inch or two shorter than him. So it's kind of a tweener position, right? He just happens to be a Hall of Famer at tweener, but I use that analogy some. As we just keep going here, I've got some comment to make about, I think I mentioned last time about closures. So a lot of our clients are contemplating closures and working with franchisors to effectuate closures where their stores aren't profitable anymore. It does make sense to keep an active look at your leases. Stay on top of your lease terms, stay on top of your escalations, stay on top of your franchise expirations, your lease expirations, and always be having that conversation of your asset mix and your portfolio. Be in communication with your franchisor about potential closures. Most franchisors, especially the publicly traded ones, do not want any closures because they don't want to signal to Wall Street that they're not making their targets. So they're going to fight for closures in many cases, but it's important that you know your franchise disclosure document and the language. Do you have the unilateral right to close stores that aren't performing well? What is your contractual obligation? Does it extend to the end of the franchise agreement? And what's the penalty if you close early? If the lease expires, but it's not coterminous with the franchise agreement, can the franchisor really ask you or demand that you open up a new store in a new location? These are things that I think we're going to continue to have to revisit over the next 6 months as we work through probably a bit of a glut of distress. And then as we turn out on the other side, just remember that supply and demand is not going to be in anyone's best situation initially. Last November at our FDC, when I was on a panel and I said, hey guys, it's possible that in 2025, multiples might actually drop, even though there's, not much inventory, just because more deals will be coming out on the market, right? And, if the supply and demand situation changes substantially, then you're going to see prices drop, even if the conditions get better. Well, what we have right now is the conditions are about the same, not better. There's been a little bit of an uptick in activity, not much. So prices have kind of stayed flat, or in some brands where there's distress, they've trended downward a little bit so far this year. That's just a little FYI. Okay, sale-leasebacks. So, I've been getting a couple of questions that I think are worth talking about. People who own franchise companies, these are mostly standalone restaurant companies, but they're also car washes and some of these other real estate heavy type of brands. So they've been asking me, like, I'm having trouble getting financed for development, acquisitions, growth, recapitalization, whatever the reason, because the, trends aren't that great and the lending community has tightened up a little bit. And, and then that would make sense. The lending community has tightened up a little bit because they look typically 3 to 6 months in arrears. And so they're just now seeing, for many franchisees, the last quarter of 2024, the credit departments are going to be tightening or loosening based on what they've seen in different brands over that period of time, because they, typically takes a while for them to see in arrears what's happening, okay? I've had a number of people call me looking for alternative modes of financing. Sale-leaseback has come up a little bit. So let me talk about sale-leaseback a little bit. Back in the 2000, 8, 9, and 10 timeframe, when it was really pretty rough, I saw a lot of people resort to sale-leasebacks in pretty heavy quantity to get financing for their company for a variety of reasons. They couldn't sell their operation, so they sold the real estate and monetized that value and put it in their pocket and operated a business that had no real estate. Maybe they needed to do remodeling and they couldn't borrow any money. Maybe it was to buy out a partner. Maybe it was to do a recapitalization of their business because they couldn't take enough out because of business conditions otherwise with their existing lender. So there's a number of reasons why, I've been getting the call now, but back in 2008, 9, and 10, I saw quite a bit of people resort to sale-leaseback as not a desperate move, but as a move that was meant to hide or prolong a problem. And many of those situations did not go well. Now, why? Because a lot of the sale-leaseback, when you sell the real estate and you're not uber focused on your terms and on the escalations, you end up with a concept. Let's say you're a restaurant and you're doing $1 million, simple math, $1 million in sales, and you do a sale-leaseback for $1 million, and you sign up for an $80,000 lease at a 7 cap rate, and you get 6.5 cap rate, and you get a $1.2 million on your $1 million restaurant. Okay. But now you have an $80,000 per year lease. Certainly in the restaurant business, if you're only doing $1 million in sales, or if it's not like highly profitable sales, 8% is meaningful. And if your sales drop another 10% and you drop down to $900,000, then all of a sudden your lease is like 11%, right? It's gone from 8% to 11%. If I did 11.2%, if I've done my math right there. The point is that the lease percentage has gone up so much that now you're having trouble making, just having positive EBITDA. And if you ever want to go sell your store, you can't find a buyer, because who wants to buy something that has no profit and a huge lease with it? So I saw that a lot. And a lot of people got in difficult workout situations because of it. Sale-leaseback can be healthy. It can be a good thing to do if it's done in the right way, where there's not distress, where it's done maybe some in isolation, but not like the entire strategy of how to monetize your portfolio. If you're growing a lot and you're doing it responsibly and you're looking for more capital to do so, it's a way to maybe take a few of your stores and do sale-leaseback, sure. But it does have big time negative consequences in a bad market. And again, number one, make sure your occupancy costs are not too high, your rent's not too high. And then dummy test it and say, what if sales go down 10 or 15%? Am I going to be able to still pay the rent here, or am I going to be in an immediate default situation as a tenant? So make sure to ask that question. Look at the lease terms. Back in the 2008, 9, and 10, we had so many I heard of so many deals going off where they would get a big sale-leaseback number immediately, and then they'd sign up for 15% lease increases every 5 years. Once you've rolled through one or two of those increases, if your sales 10 years later are less than they were 10 years prior, you're on 14 or 15% of sales leases, and your business is unsellable and probably close to bankruptcy. So watch those escalations after 5 years. Love to have those around 1 to 1.5% if you can get them, but you certainly don't want them at 2 or 3. Just need to understand that keeping the real estate was always a good idea in the good old days. Very few people did sale leasebacks at all prior, in my knowledge, to like the mid 2000s, like 2005, 2006, kind of that time frame. And I know we didn't have the private equity model that's seeking high IRRs and MOICs. We had operators that wanted to own their business for 30 years. There was a reason why they didn't do sale leasebacks, right? They kept the real estate. It was a good way to create long-lasting legacy value for their businesses. It could be sold at a low tax rate. It was just flexible is what it was. So if an operator wanted to move their location across the street, or they wanted to build a new store, or they wanted to offset a store to a new trade area, if you own the real estate, you could do that. You could make decisions that didn't tie you into a long 20-year situation in exchange for money now. So those are just some things to keep in mind. Clearly, it's still a strategy. The 1031 market is out there. It's still not very strong right now. It's we talked about over the last several months, as there's just not much commercial real estate that's been moving. So we expect that market to kind of unthaw slowly over the next 6 to 18 months, I would say, not unlike what's happening in our franchise space. I will say, as I change directions here, that if you find a good transaction or a good business that you like, again, is it a good time to buy it? It may be. I mean, the conditions have changed so much. If you're able to pick up a business either that's been struggling a little bit or one that is down in EBITDA historically over the last 4 or 5 years, may be a nice time to get into the market if you like the brand and you like the performance and you like the future. The model of buying a franchise business for huge unit growth and huge sales growth, I mean, that's a way to do it historically. Right now, though, I might ask, what about buying a business that's not performing that well, that you could buy at a low multiple, that, you don't plan to really grow it that much, but you just plan to use it as an annuity if you can get in at a low enough kind of multiple and use that as a base of operation and as a profitable ongoing operating business that doesn't have a whole lot of value when you sell it. Those kind of opportunities, even for financial investors, really exist, and the calculations are kind of changing as the multiples drop. Like, instead of thinking about an investor coming in to buy a business that they're going to buy 100 units and then build another 30 units, experience 5% EBITDA growth, 3% sales growth, and then recap the company when interest rates go down to 2%. Maybe instead it's a 100-unit business for a 3 times EBITDA multiple and a languishing brand that has a really nice return, even if you assume your exit multiple is a 2 times number in 7 years, just because it's in a cash annuity business. I mean, the returns actually might look decent if you get back in and you just kind of look at it a little differently than you've thought about it in past years. That's a short explanation of MUFC, of kind of the current trends. Deal flow continues to be low. We're hopeful the summer will bring back a little bit of volume. I'll be out at a couple of Wendy's conventions in the next 60 days, and then certainly this fall out to a couple of the other big ones too. Hopefully, Wingstop and Taco Bell and maybe Zaxby's and RFDC and some of these other conventions. I'm going to be at the Pizza Hut convention next month. So for any of you who are listening or watching, please feel free to reach out to me. If it's been a while since we've spoken, I'd love to talk with any franchisee who's out there and wants to chat. And wish everyone the best. Let's hope for better times ahead. Take care. Thanks so much for entering the Boiler Room today. You can find our podcasts on iTunes, Google Play, Stitcher, TuneIn, and Spotify. If you like these podcasts, please listen, rate, and review. I also encourage you to visit our website at www.unbridledcapital.com for the best franchise M&A and financial resources in the industry. Our website includes webinars, podcasts, videos, white papers, and a list of our past M&A transactions. Please note that neither Rick Ormsby nor Unbridled Capital Advisors LLC give legal, financial, or tax advice. The These podcasts represent opinions that have been prepared for informational purposes only. We expressly disclaim any and all liabilities that may be based on such information, errors therein, or omissions therefrom.